Welcome to this market and economic update. In this video, I'm going to discuss Fed Chair Jerome Powell's recent Jackson Hole speech and what it signals about the upcoming rate cuts, the bond market, and the overall economy. I'm going to explore why market confidence in the Fed matters so much for investors, examine the economic data driving policy decisions, and look at what rate cuts could mean for your investment portfolio. Going to start by understanding why the relationship between Fed credibility and market confidence is so important for how monetary policy actually works. While the Fed sets short-term rates, longer-term interest rates that affect things like mortgages and corporate borrowing are determined by markets. This means the Fed policy only works when investors have confidence in the Fed's ability to achieve its goals. One way we can measure this confidence is through corporate bond yields. These yields represent the interest rates investors require to lend to companies based on risk. They generally do fall when the economy is healthy and corporate profits are growing. Today's market environment suggests that this confidence remains strong as corporate bond yields have fallen and are near their lowest level in years. Now I'm going to turn to what Powell actually said at Jackson Hole and what it tells us about Fed policy. Powell acknowledged the delicate balance between the Fed must strike between controlling inflation and supporting employment. He did note that risks to inflation are tilted to the upside due to these tariff impacts, but also emphasized significant risks to employment to the downside. Recent economic reports illustrate this challenge. There are early signs that companies are beginning to pass on higher costs to customers, which could drive prices higher. At the same time, the latest jobs report was much weaker than we had originally expected. So essentially, the Fed appears to be positioning for cautious rate cuts to balance out these objectives. So what do potential rate cuts mean for your investment portfolio? Historically, falling policy rates provide support for bond prices, since existing bonds with higher yields become more valuable. The U.S. aggregate bond index has generated a total return of 4.8% just this year, partly reflecting these different dynamics. Lower rates also typically reduce borrowing costs for companies, which can drive growth. This can also support higher valuations, particularly for growth companies, since these lower interest rates mean their future profits are worth a little bit more today. Ultimately, the benefits of lower rates need to be balanced with valuations that are quite high. The best way to do so is not to try to time the market, but by holding an asset allocation that's tailored to your financial goals. We do hope you found these insights helpful. If you'd like to discuss these topics or anything else, please don't hesitate to reach out, and we look forward to speaking with you. Thank you.